The broadcast is now starting. All attendees are in listen-only mode.
Hey, good afternoon, everyone. Real quick before we get started, let me just know if you could type in the question box if you can. You should see a screen up there that says Intro to Touch Brackets, and if you're hearing me all right. Of course, if I don't get any responses, all right, sounds like we're good to go. Happy New Year, everybody. I hope 2019 is getting off to a great start. Boy, the markets certainly were crazy enough to end 2018, and it doesn't look like that volatility is going anywhere too soon. Very happy you could be here. We're going to talk about the new touch brackets today. 2019, exciting year. 2018, also exciting year. Hopefully you've all had a chance to check out the Nadex Go app. That was one of the big developments that we received just some great feedback on. And I think the reason we got such good feedback is because all of the changes, all of the development were based on feedback from our members and things that they wanted to see. And we're going to continue to develop that. But today I'm very excited to talk to you about the launch of the contract called Touch Brackets. I'll tell you, it's been a lot of work, but it is absolutely the coolest project I've ever been involved in, really in anything I've done professionally, probably actually in my life. Again, feedback on this has been amazing. It's something that I think can truly revolutionize trading for the individual. We've got all different types of experiences, and I think one of the coolest things, and we'll talk about it as we go through the presentation, but one thing I want you to keep in mind, whether you've been trading, whether you're new to trading, whether you've been trading for a couple of years, whether you've been trading for 20 years, we all do what I call get human. And one of the coolest things that we're going to touch on about this contract, but I want you to keep it in mind in the forefront, is the plan that this contract offers, your trade plan, right? How often, and be honest with yourself, how often in your trading history have you ever had, you get into a trade, it looks perfect, the market starts moving against you, and all of a sudden you want to move that stop, or you have a mental stop, right? Or the market's really roaring in your favor and greed kicks in, and all of a sudden you say, oh, wow, I should have taken profit because the market just retraced and I never locked it in. Happens to all of us. And it happens to all experience levels. So if you're new, don't think that that's just you. It's the human experience. And this is something that this contract can really help with. Now, before we get in, and I'm not going to take too much time here to get into the meat, but we do have a lot of people on this presentation today, hundreds and hundreds, which is so exciting. I'm very excited about this contract, as I mentioned. But a couple of housekeeping tips. This contract is being recorded. I know that's always a question that comes up quite a bit. We've got a lot of material to cover in a fairly confined time. So there will be questions at the end. If they come to your mind, go ahead and type them in the question box. Again, we've got a lot of people in here. I'll try to get to everybody's questions, but I'll be taking those at the end because a lot of those questions will be covered as we go through. So if you have a question, just type it in the box. With that, let's get going, and welcome to this intro to touch brackets. What we're going to cover today as far as an agenda, we're going to cover really all the aspects. What are they? How do they work? What's the risk-reward profile? I recognize a lot of names on this webinar. A lot of you I've known for years, and I always harp very much on risk. And again, like all contracts that we've talked about at Nadex, this one I think really helps to define that, as well as the reward and the natural targets for those. Capital requirements, we're going to walk through a full trade example. And we're going to talk a little bit about the effectiveness of leverage, or the leverage that this contract can really offer, and how it does that in a positive way as opposed to issuing up margin. And then, of course, at the end, we'll get to questions. So if I'm talking a little bit fast, could be my excitement, but also I see the slide deck here and I know how much we have to cover. Before we begin, though, everybody needs to understand that trading on Nadex, or really trading on any market, involves financial risk. Right? You put money in the market, you're putting up risk, right? You can lose any money that you put up for a trade. Now at Nadex, you can't lose more than that, which is one of the huge benefits, and you've heard me harp on that before, is always understanding and defining your risk up front. As we've seen, the markets, they can be volatile, right? So we can lose the money on those investments. We're going to be talking about the markets today. Any trading decision is your own. We're looking at a market. Don't think that this is a solicitation from me for you to buy or sell any financial instrument here or elsewhere. So with that, let's begin. So what are they? I know a lot of you haven't had a chance to try them out. We launched them. We're just really about a week and a half into the live launch. So a lot of you have had a chance to take a look at them. But what are they other than revolutionary, which I already touched on? So basically, a Nadex touch bracket is a contract that trades within a price range. The range has two price levels. We've got the low price level called a floor, high price level called a ceiling. Hopefully, I haven't lost anybody yet. We will get into a lot of chart examples as well, so if you're more visual, hang tight. Between the floor and the ceiling, and this is what's really cool about this contract, it moves in linearity with the market. It's very, very linear contract. So if you've been trading forex or you've been trading futures, we're going to go through some benefits of this contract. But the linearity of it should look very similar when you're actually trading it and in a trade watching the market move, how the price of the contract fluctuates in linearity with the market. If the Nadex indicative index for that market touches or surpasses the floor or ceiling, that contract is expired immediately at that value. And again, we'll take a look at examples of all these concepts. Each touch bracket has a maximum duration of 1 week. At the beginning of the week, we're going to list 4 touch brackets per market. Currently, there are 8 markets, 4 currencies, and the 4 U.S. Stock index future markets. Of course, we're always looking to innovate. I would not be surprised if you see a few more coming down the line anytime in the near future. So in the event a floor or ceiling of a bracket is touched and expired, a new bracket will be listed. So we always want to keep a market for our members to trade. We always want to have that opportunity. In almost all conditions, there will be 4 unique touch brackets to choose from, each with their own range. So let's take a look at this visually. So in this case, we've got the US 500 with an opening level at the week, say, of 27.20. If you see it on the left there, that's the price. We're going to launch 4 brackets. Now you might notice the stair-step pattern there, and I'll explain why that's so important to finding opportunity whether you want to be long or short, particularly when it comes to relisting. As a visual reference, that blue line is the start of the week. As you can see, all 4 of those brackets, price is contained within. You might notice that for bracket 1 and 2, the price is closer to the floor. Bracket 3 and 4, the price is closer to the ceiling. So in the case of the US 500, we have 4 brackets, 50 points per bracket. The whole concept of design is to give you opportunity to trade long or short with precise risk management skills and still plenty of upside. So for the US 500, the ranges are 50 points. For the currencies, they're all 250 pips or points, depending on how you want to look at it. But look at each market, and each market is designed based on the historical movement of that market. And of course, 1 week in duration, so they have an expiration time. So let's take a look at how they work. Right? We already discussed it trades within a set range, which is capped by the floor and the ceiling. They can expire in one of 2 ways. They can either expire by price, which would be considered a touch, which we'll talk about first, or time. So if either the floor or the ceiling are touched or surpassed, the contract is immediately expired and settled at that level. Once the contract is expired by touch, a new contract is created to replace it at a new level. And this is going to be based on, as we'll see in the next example, where that previous one was touched. A touch creates the immediate expiration. It's defined as the ceiling. So if the Nadex indicative underlying index is equal to or higher than the ceiling, so maybe you might get a gap in a tick or two, if it's at or higher than the ceiling, it will be immediately expired. By the way, this also takes place even over that 1 hour period where we're closed each day. So if a ceiling is touched or a floor is touched over that time, they will be settled near the exchange open and the new contracts will be listed. The floor. So if the underlying indicative index is equal to or lower than the floor, then that contract is expired at the level of the floor. In the case of one bracket or more being expired by touch simultaneously, the number of new brackets required to bring the total number to 4 will be created. Now this has one caveat. Anybody remember the Swiss National Bank pulling the peg a few years ago, right? Some pretty extreme market conditions. Maybe not so extreme. Sometimes we look at those and call them black swans, but anybody paying attention to the yen a week ago? It happened to be over that closed period for Nadex. If four are knocked out simultaneously, meaning we have a market gap, we'll actually go to a manual relisting, right? We want to make sure that we have stable, clean markets for our members to trade. And so oftentimes, if we do see a big move like on the yen, we'll take a look at the market, see where it's at, make sure that everything happened the way it should, right? Again, we have a huge responsibility to protect the integrity of our markets. So in situations like that, we might take a little bit of time to get those back up. It's often very quick. Well, often we've only been in a week and a half, but in this case, it was very quick. But again, we need to take a look at those markets. In most cases, though, you're going to see four at all periods in time. Let's keep it simple, though. This is really the same as any market. You buy if you think the market's going up. You sell if you think the market's going down. As a trader, your job from that point is to have a plan for risk and for your take profit level. So let's take a look at how this works. Right? This is the same scenario we just looked at as far as the bracket levels. If you pay attention to price on the right, the price just moved up. It hit the ceiling of bracket number 4. Right? So bracket number 4 is expired at that level. Once that happens, a new bracket is created almost simultaneously. This new bracket has a floor that's the closest now to the actual indicative underlying market. So in the case of an uptrending market, you'll actually see these, if they continue to get knocked out, go in an upward stair-step pattern. Now in every situation, you'll always have two brackets, which have a more beneficial risk profile for shorting the market, and two brackets, which have a more beneficial risk profile and bigger opportunity if you're going to be long the market. So let's take a look at a floor being knocked out. Same scenario. In this case, it was bracket number 1 that was knocked out. That's immediately expired at that level. So in this case, say it was 2,700. A new bracket then is again immediately created. If you want to continue with that downtrend, and we're going to talk about locking in profit and what these can do for that. Also limiting your risk when we walk through the trade example. Is everybody with me so far? And I know we've got a lot of information here, so just want to make sure we're all on cue. Sounds like we're good. All right. So we talked about how brackets can be knocked out based on a floor or ceiling contact, right? If they hit it or surpass it, they're going to be immediately expired at that. If these contracts at the end of the week are still active at expiration, they're going to settle by time. So they're 1 week in duration, will expire on the last trade date of the week. Typically that's going to be a Friday, but obviously, sometimes holidays fall on different days. So if it is a holiday, maybe that last trade date is a Thursday or whatever that last trade date is. So, but typically in most cases, it's going to be on a Friday afternoon. Of course, you can always look at your order ticket and see exactly how long till expiration and know exactly when that's going to be. For many of you that have been around Nadex for a while, you know how we do our expiration value on binary options on touch brackets, on binary options and call spreads. Touch brackets will be the same way. So say, for instance, at 3 o'clock Eastern on a Friday, we'll have our expiration value calculated. Everything expiring at 3 o'clock, whether it be a binary option, a call spread, or a touch bracket, will have the exact same expiration value. Positions in touch brackets remaining at that point will be settled using that exact expiration value calculation. They're considered variable payouts at the final expiration. So unlike binary options, which are all or nothing, these are actually going to be variable, much more akin to the call spreads from a settlement type procedure than a binary option, which is all or nothing. The profit and loss will be determined by the difference between where the position was bought or sold and the final settlement value of the contract. So let's take a look at an example here. We'll say this is Friday afternoon. We've got 4 brackets remaining, and the market's right around 2780. So it doesn't matter whether you're in bracket 1, bracket 2, bracket 3, bracket 4. That level will be the expiration value for each bracket. So let's walk through that. Let's say, we sold when it was close to the top of bracket number 1, and we'll just say that was around 28.20. So this expiration value we'll just call 27.80. If I sold there, I'm going to get the difference between where I sold and what that final value is. So in this case, that'd be about 40 points, right? So it depends on where you bought or sold to the final expiration value. Obviously, if you bought, you want the final expiration value to be over where you bought. If you sold, you want the final expiration value to be below where you sold. But it will be variable as far as the payout at expiration, depending on the level of the Nadex indicative and what that settlement calculation is. So let's talk about risk and reward. Again, as many of you have heard me speak over the years, I'm a huge proponent of defining your risk, of understanding what it is. Also, you need to understand what your reward is. What are your targets? So let's take a look at how this provides a natural profit target as well as risk, maximum risk protection for your trades, right? You need to know your maximum risk. This is something that a lot of contracts don't offer, right? Have you ever sold a call, right? There are plenty of horror stories about people that sold calls to collect premium but didn't actually define what their risk was. You can find horror stories all over the internet. I don't have to share those with you, right? So define it up front. Similarly, in very highly leveraged markets, you look at the currency markets in like the early 2000s when you're getting like 400 to 1 leverage, right? The difficult part with that being margin is you weren't really defining the risk. Trust me, again, horror stories coming out of those days from people that just blew up their accounts. This contract does not allow that. Trust me, you can lose everything you put up on one trade, but you can't lose more than that. So this is very important. The floor to ceiling boundaries provide pinpoint control over risk, right? Because you can't move your stop. You know when you enter that trade with 100% certainty, what is my maximum risk? Does not matter what happens. I don't care if it's geopolitically. I don't care if it's hurricanes, an invasion of snakes. I don't care what it is. Whatever moves the markets, you can never lose once you're in that trade beyond what that floor to ceiling boundary is, depending on if you're long or short. Also, it has the natural profit targets. And if those targets get hit, right, it's going to automatically make you collect that profit, right? So no more if it went past the ceiling and you never put a limit in, sitting there saying, oh, well, geez, it went up. And then all of a sudden I got greedy and now it's shot back down and now I'm at break even or worse, right? So if it hits that ceiling or floor, depending on if you're long or short, it's going to lock in that profit. Now, don't get me wrong, right? You still need to look at these as a trade. So, right, you can use limit orders and you can close out early. We'll talk a bit about that in the trade example. So we do have, hopefully I've stressed enough, and what I said was really exciting along with many other factors, is that built-in plan for every trade. So on the risk side, maximum risk is the difference between the buy price and the floor. Seller's maximum risk is the difference between the sell price and the ceiling, right? Reward is just the inverse. Buyer's potential reward is maximum at the ceiling. Seller's potential reward is maxed out at the floor. So let's take a look at it. In this case, we're just going to use bracket number 1, right? Let's say that we're going to be long. So in this case, we would either look at bracket 1 or bracket 2 probably, because they give us the most benefit from a risk-reward perspective. Now, one thing to keep in mind when we're talking about risk-reward, right? If the market's dropped and it's very close to bracket 1, have your plan. It might be more beneficial, actually, in some cases, to choose the bracket with a bit more risk and give the market a little bit of room to breathe. We'll touch a little bit more on that in a bit. But for now, let's focus on bracket 1, and let's go through and construct this bracket. So we have a starting point, right? Beginning of the week. We have our end point. That's the maximum time this contract can trade. Now, it can be knocked out before that, but that's the maximum time, that red line. That's expiration. We have a floor. In this case, 27.10, which is 10 points below the indicative underlying at this point. We have a ceiling at 27.60. If we place this buy at 27.20, our risk is that 10 points. In this case, that would be $100. This is on the US 500. So always make sure you understand your market. By the way, you'll always also see on your order ticket what your maximum risk is before you hit buy or sell. So always make sure that falls in line with your risk tolerance, right? I think these are great contracts, but that doesn't mean you can get away from your rules on your maximum risk per trade, right? If my maximum risk per trade is only $50, I can't take this trade. If my maximum risk is $200 per trade, maybe I take 2 lots, right? So always understand that in the scope of your overall trading plan. So here we would have $100 risk. From 2720, we have 40 points to the ceiling. This is a $500 contract, so anybody quick at math? If I've got $100 risk and the contract total value is 500, yep, my maximum potential return, not including exchange fees, which are the same for touch brackets as there for all of our other contracts, not making it, want to keep it simple and not confusing. That's what we're all about. Return profit potential of $400 on this particular position for a 1-lot trade. On the opposite side, right, if we're short, our ceiling is there to help limit and define our risk, right? So in this case, if we're selling at 2720 and our bracket, perhaps that was bracket number 4 from the downward stair step that we looked at before, right? Creating opportunity. Maybe we thought the market was going up and it was time to reverse. If we sell at 2720, our ceiling's 2730, we've got 10 points risk. Again, $500 contract. We've got $400 potential return on this, right? So depending on where it's trading at in that range, if it's trading, say, at 27.25, then we only have 5 points risk. Now, we may determine that 5 points isn't enough for the market to breathe, so we might choose another bracket. But because of the structure, there should be another bracket there to choose. So capital requirements. And I can guess there's already plenty of our members here on this call that already know how this is going to be defined, right? You know your maximum risk before the trade is placed. And how are all capital requirements defined on Nadex? They're equal to the maximum risk. That's why you can never get a margin call. That's why you can use something that actually has really high, what I'd call effective leverage, or you could even call it leverage, but you don't risk having to ever call your significant other and say, geez, I thought the Dow was going to 29,000 and all of a sudden it just fell 4,000 points and geez, now our kids aren't going to college, right? You defined that up risk. By the way, just to clarify that, you can lose whatever you put on your trade. If you put your entire kid's college fund on one trade, then I won't even say it, right? You can lose everything you have on one trade, but you'll never ever lose more than is expected on that. So hopefully nobody does that. Hopefully you still stick to your plan, right? If you've got $1,000 on, you don't want to put $1,000 on one trade, right? You want to stick to a sensible risk ratio per trade. Capital requirement never changes. This is actually a huge one. I know we've got a lot of futures traders on the call. This capital requirement, if you've traded things and say you've day traded futures and you've always thought, oh, geez, I'm in this position. It's just starting to work as we get towards the end of the day. You know how sometimes before the close, it really just starts to move. I really want to hold on to this position, but I'm trading, I'm trading in this case, if it's a future, the ES, which is what the US 500 is based on, I'm holding the ES, but we're getting towards that close and I had $500 intraday margin, but all of a sudden, now I've got to put up $5,000 to hold this trade. I can't do that, right? So I have to close out. I have to get flat. The capital requirement, once you're in a touch bracket trade, never changes. There's no overnight margin. Your risk is always defined, right? And so that's never going to change. So these effectively become as easy to swing trade as they are to day trade. And to me, that's a huge benefit. I've worked with futures traders for a long time. A lot of us have day traded futures. Those capital requirements can get really, really stiff. Also, when markets get really volatile, it's really not that uncommon to see margin requirements change. Not the case here with these touch brackets, right? Because once you're in that trade, it's always the maximum risk, and that never changes. And that's the same for buying or selling. It doesn't matter if you're buying or selling. Capital requirement is always the risk, right? The whole structure of these brackets are designed to minimize the capital requirements, right? So that you can get into a trade at a sensible level that falls in line with whatever your risk capital is for that particular case, where you can manage that, do it sensibly, and because of the multiple brackets, that's exactly how they're designed. Provide you that opportunity. You get all the benefits of leverage, and we'll take a look at how that leverage plays out in just a little bit here, but you get all the benefit of leverage without that unknown risk. Ask anybody who was trading around the Swiss National Bank when they pulled the peg. And I'm going to guess everybody, I'm just going to throw this out, I'm going to guess everybody here isn't looking just to trade for a week or two, or maybe the next couple months, right? We want to do this for a long time, right? Time is our friend. We want to do this for longevity. Well, and it's kind of funny. I'll tell a funny story. When we're going through and speccing out this contract, right? We were talking about different scenarios, and thankfully we planned for them, right? That's what our job as an exchange is, to think of all the different scenarios and then prepare for them. And we were talking about, what happens in this event? What happens in that event? What happens in the event of like a Swiss National Bank? What happens in 2007 when there was action by 4 central banks and the currency markets just went crazy and moved like 1,000 pips in one tick? What happens in those scenarios? And we kind of thought, well, we're planning for this. This is good, but really, what's the probability that's going to happen? And then a few days into the contract, it happens with the yen, right? All 4 got knocked out, right? So we prepared for that. Something to keep in mind, right? If you're trading those leveraged markets, right, and you want to trade forever, right? If you're working on a highly margined contract, you have unknown risk, right? If you have a 30 pip stop on, say it's the Swiss National Bank, you have a 30 pip stop on, and it goes against you in a situation like that, you're not going to lose $300 per contract. You're probably going to lose closer to $15,000, $18,000. I can't remember exactly the severity, depending on which pair you were in that time, but this is the whole thing, defining it, right? And you need to be able to define it every single trade. So this might seem a little bit redundant, but I want to make sure all these points are crystal clear, right? So this is the same scenario we saw, right? We've got 10 points risk on this trade. Each point in the case of the US 500 is $10, so 10 points times 10, $100 risk. That's our capital requirement. And it'll always say that on the order ticket. You'll always see what your maximum risk is. You can look at that and say, oh, okay, that's my capital requirement. Hopefully this is that part's pretty simple, right? So let's walk through a trade example. And I've been talking a lot here. I'll be getting to your questions here in just a little bit. Again, a lot of information to cover. All right. So this is the Wall Street 30. So we'll say we have an opening price of 24,375. This whole formulation should start looking very familiar to you, right? We could choose any of these brackets, right? Now, if we choose bracket 4, we don't have very much upside to the risk, for what our overall risk is. Same with bracket 3. We're going to have more risk on the trade than what we do potential upside. So in most cases, we'd look either at bracket number 1 or bracket number 2. In this case, for illustrative purposes, right, because each trade is different, so always understand that. Just because you're getting into a super low risk trade doesn't mean it's the right trade. Always consider what that is, because if it's only a couple of ticks off the floor, say even a couple of points off the floor, that might not be enough room to really breathe. So we've given you a couple of options with these contracts. So we've got our expiration at the end of the week, but let's take a look at bracket 1. We've got what seems to be a pretty generous risk to reward ratio on the overall aspect of this trade. So let's lay this out. We've got our floor at 24,275. We've got our ceiling, 24,775, right? And we've got our expiration at the end of the week. Let's say we're buying it 100 points off the floor. Now, in the case of the Wall Street 30, each whole point is $1, right? So 100 points between where we're buying and the floor. This, by the way, is also a $500 contract. This is our risk. So we have $100 risk. That's our maximum risk. Maximum potential return, you guessed it, 400 bucks. So all of the stock index-based contracts, with exception to the Tech 100, which is $600, all of those are $500. But again, on your order ticket, it's going to tell you what your maximum risk is as well as your maximum potential return. So let's walk through this trade, right? You can close out these trades early, right? One of the key premises that I've heard from experienced traders, and I've taken it to heart. I'll tell you, a mentor of mine one time said it, I think, best. He said the only difference between him, and he'd been trading about 30-some years at that point, the only difference between him and a newer trader was that he got out of his losers faster. So just because you have your maximum risk defined, that's a maximum level. If what you thought was going to happen didn't happen, you can make an attempt to close out this trade. Try to lock it in. So instead of taking the full loss, right? If you're wrong, admit you're wrong. Now, the nice thing about having this floor here is you already knew the maximum amount of wrong you could be. My wife would love to have this contract in our personal life, but unfortunately she doesn't. But knowing the maximum amount of wrong you can be, right? So if this market was at 24,375 where we got out and it just didn't go in our favor, maybe it's sitting at, we'll say 24,300, we're down 75 points. We might make the decision there to close it out. Or we might say, you know what, it's actually just hit a level of support. We knew what the market we thought would have the room to breathe. So let's just let it play out. Either way, we know that no matter what happens in the world, we can never be slipped past that level. I don't know if anybody's ever had that happen where you've got a stop in the market and it's approaching your stop. And you're like, well, it's getting close to my stop. I'm going to let it play out, but this one could be. And then as it gets to your stop, all of a sudden it slips like a couple of ticks. And you're like, wait a minute, I didn't get my fill at the level I thought. You can't get slipped on this contract. You also can't lose more than that $100. So even if the the Wall Street 30, based on the Dow Mini, falls to 24,000 even in one tick, you can't lose more than where the floor was. It's not possible. So you've got that safety net, right? So let's walk through this. Okay. Whoop. There we go. You know what? The market rebounds. Awesome. It didn't hit our lower limit. We're still in that trade. Now it's moved up. Now, a quick point here, right? You don't have to wait for that maximum profit. You can take off a partial or a full position along the way. So let's say you traded a 10 lot. Maybe the market goes from 24,375. Your maximum potential return point is 24,775 at the ceiling. Maybe you say you want to take off 5 at 24,675. You want 300 points, $300 each. You want to take 5 contracts off and then see what happens with the rest, right? You have that flexibility. So just because this has the built-in trading plan, you also want to think like a trader, right? Because if all of a sudden the market moves up in your favor, and whatever type of analysis you're doing, maybe it's technical and you're starting to see a reversal, don't get greedy, right? If the market's indicating to you that it's getting ready to reverse, you can still close out this position, right? If you're trading these around a fundamental announcement, you might want to stick limit orders out there along the way anyway, just because of the severity or the quickness of the moves the market might make. In this case, though, let's just say we held on to it, happy days. It hits our ceiling at 24,775. That level is knocked out. We've automatically collected, right? We're not still holding this and all of a sudden seeing a severe downturn. We've already locked that in from where we bought at 24,375. Doesn't matter what happens to the market now. If it does a severe reversal, we've locked in at 24,775. We're not giving it back to the market, right? One of the huge flaws all traders have made is giving profitable trades back to the market. Many of you that have heard my trading plan webinars have heard me preach on that, so I won't go too deep into that. All right. Again, right, we had a contract, a touch bracket that was immediately expired. It was knocked out, right? We have a new contract that's listed, right? Our previous level that was knocked out was 24,775. Now we've got a new contract with a floor at 24,675, 100 points, right? Similar structure. Now we have an opportunity again to get long. If we think this market's still going to continue up, we can get long. So let's say we buy it, we gave up a couple of points. We're at 24,780, right? So we have $105 risk on this trade. And we're in again. But again, if the market makes a severe reversal, we've already locked in that profit from our first trade. Now it's considered almost like a trailing stop as you move from bracket to bracket to bracket. You can't possibly give it all back, well, unless you actually do a total reversal and it continues to go against you. But on this particular trade, you're knocked out if it hits 24,675. So the remainder of that profit from the previous trade is automatically locked in. So let's say this happens. Okay, we got some good action, and we go to expiration. We have an expiration value of 24,990, right? So recall, when it goes to expiration, it's variable payout. It's not all or nothing like a binary. It is variable. So the difference between 24,990 and the 24,780, or the 210 points, that's our profit less exchange fees, right? Again, though, we could have closed out before expiration, maybe as the market started going flat, the flexibility. But either way, at the end of the week, that contract is going to expire. So you're not holding positions over the weekend. You're not taking that weekend exposure. But from the previous trade, you locked in that profit as the market continued to go up. And that's what we want to see. You know, we've had markets really all over the place, which have been just crazy to watch. I mean, it's created some huge opportunities across a lot of different markets. Also some huge risks depending on the contracts you're traded, right? Benefit of defined risk and being able to pinpoint exactly what that is. But if the market's trending up, right, you can continue to have opportunity. And if you continue to be long and you can move from contract to contract, right, or if it's downtrending, you can continue on the short side along the way. Continually, as it knocks out and you move to the next one, you're locking in that profit. That's a very key point. If there's one thing that could help traders, no matter what you're trading, is if you can get that concept down, you're going to be so far ahead of the game. Obviously, no guarantees of success, but that's a key point. And I think that's one of the huge, beautiful things about this contract. Let's take a look at leverage, right? I mentioned before how dangerous leverage can be, and the reason I say leverage by itself, in how it's commonly known, is usually based on margin, right? You put up a small amount of margin to hold a much larger position size. Now, this disclaimer, margin rates, as I mentioned, they can change, right? This leverage is for illustrative purposes only. Margin rates on underlying markets may change, based on, what's happening in the markets. They may change on the value of the contract. Again, with Nadex, the effective leverage could be slightly more, slightly less, but let's just walk through this for illustrative purposes. So if I'm looking at trading something like the ES, which is the equivalent of the US 500, right? My margin required, if I'm going to hold that overnight, at the time this slide was done, is $6,380. Now I can day trade it for $500 at a discount broker firm. Right? If I'm trading it at $500, I can get 291 to 1 leverage. Now, I haven't defined my risk necessarily, right? Because that's just margin. I'm putting up $500 to hold a $145,000 position, right? So what happens if that position all of a sudden becomes $140,000 and I lost $5,600, right? That's why overnight you need to put up that $6,380 to protect from moves like that. As you can see there in the margin required, depending on what you're trading, is it the Russell, the NQ, which is what the US Tech 100 is based on, right? So you get some discount margin, but you still haven't defined your risk. On the currency side, right, they've set different margin rates as far as what's allowed. So, on the Euro USD, say the mini spot, you get 50 to 1, you put up $234. If you're trading something like the dollar yen, it's 25 to 1, which is still a lot of leverage. It's a lot of leverage to utilize. But if you look on the far right at the collateral requirements on Nadex, and this is based on if you did the trade at the open, right? Which in the case of a currency, we have them in 50. They're 250 wide. So when they start out, you'll have one contract that's listed with 50 ticks to the floor. There's one that's 50 ticks to the ceiling, right? Long or short. And then 200 to the upside. So if you got in there right away, now if the market moves down a little bit, and let's say it moves down 5 ticks, right? So instead of putting up $50, you put up 45, or maybe it moves up 5 ticks and you put up 55 instead of 50. You still get a huge amount of effective leverage without that unknown risk. So you get a lot of power in your hands, right? But you've defined what your worst case scenario is, and that's so important. Now, if you're looking, and some people I've talked to are starting to look at strategies for hedging and different things with these contracts, there's what I call a multiplier, right? So the point value on the Nadex US 500 is $10. On the ES, which is what the US 500 is based on, is $50, right? So in order, if I'm looking to equalize that, the Nadex multiplier is 5 contracts, right? Because if I multiply 10 by 5, it's the $50 per point. For the Wall Street 30, which is based on the YM or the Dow Mini, that's again a multiplier of 5. Same thing, US Tech 100, multiplier of 5. Small Cap 2000, multiplier of 5. Nice and simple. And so this really puts the power of leverage in your hands without all of those unknown and nasty surprises. Most of all, margin calls. I know, I'm sure there's some people on this call. We have so many people that we've all seen that ugly scenario unfold, and it's definitely no fun. All right, so I've got a whole stack of questions here. So let me try to get through these real quick. I'm going to do my best because I'm going to have to scroll through the pages here. Give me one moment. Okay. Yep. Just to reiterate, because I see a couple of these, this is recorded. Since you're registered for the webinar, this is recorded and it will be sent out. In the meantime, if you'd like to check out some of our education, just go to the videos section. We've got some great videos that'll reiterate these key points, as well as some written content in the Education Center. By the way, really interesting, there's going to be a lot more education coming out on these. We've got webinars coming up in the next couple of weeks that are going to be awesome. They're going to take a look at analyzing the market. So if you look at the Education Center, definitely check out the webinars. We've got a couple more coming up in the next couple of weeks. We're going to continue to create a lot of education. This is still really early days, and we're going to be cranking it out. As you know, we have a lot of great third-party educators. They've had some great feedback for us. Interestingly, if you went to Google a few weeks ago and you did a search and you said, I did this and I just did touch brackets, Google would ask, did you mean touch bracelets? Now I have no idea what a touch bracelet is. I went there earlier this week and you're starting to see videos come out. You're starting to see people that are trading these that are as excited as I am, which to me just warms my heart. And I think it's great for all the people that put in so much work. And I really want to thank our development team, our compliance team, our marketing team, our ops team, teams across the board that put in all this work because the feedback's been amazing. So yeah, so let's see the point value on the example of the stock. So okay, as far as the thing, and let me click back to this slide here. We've got a question on as far as the point value. So on the point value, so in the case of the US 500, there's 10 ticks per point. So in the case of a full point, right, it would be $10. It's actually $1 per tick. All of the touch brackets, and thank you for that, I should have clarified, all of the touch brackets are $1 per tick. In the case of the US Tech 100, it ticks in quarters. So that's $4 per point. In the case of the small cap, there's each point has 10 ticks. That's $10. So hopefully that helps clarify that question a little bit. So when we're looking at it on a point-by-point basis. Oh, thanks, KM. I really appreciate that. Just want to share this comment. Yeah, awesome job to you and your team. As far as this is a great question as well. Probably, Doreen, I'm guessing you have seen our call spread contracts, which are actually much more along the lines of optionality, right? There's no premium. These move very linearly with the market, so you don't have that premium. It looks like, I mean, it is effectively like it's linearity with the market, right? So you'll look at where the Nadex indicative is, and you'll see that price. Great question, Leonard. So the Nadex multiplier. So if I was looking, let's say I was trading the ES over, that's a CME contract, that's the E-mini S&P, and I was trading one contract of the ES. I have $50 per point. So if I was looking to do it something like a hedging scenario, and the reason I brought this up was because I've been asked this question a lot. If I was looking to offset that on a one-for-one basis, the Nadex contracts that's based on the ES is $10 per point. The ES is 50, so I would do 5 Nadex contracts, and that's what's meant by the multiplier. Another great question, Mark. How often do brackets renew in a week in Forex? Well, if the floor or ceiling of no bracket gets touched, then it's the same floor from the beginning. Now, what we've been seeing, particularly in these markets, is that we actually see quite a few knockouts. So it will depend on market conditions, how many brackets. But if one gets knocked out, the next one will be listed, you know, virtually immediately. Let me see. Yes, currently only weekly contracts, but again, these can be day traded, right? If you're looking for a move on the intraday, but yes, currently only weekly contracts. Let me see here. I've got to get my, I've got to scroll here a bit. You guys are keeping me busy. Touch brackets are available on the demo. They're also available in live. I see that. Ooh, killed two birds with one stone here. I just saw somebody ask if these are available. Yes, they are available. And so they are in the live environment. Let's see. I'm just going to clear out a few questions here. I see. Okay, this is a great question from Randall. I see binaries and spreads are available on the Nadex app, but not touch brackets. That may be because if you're using one of our old native apps, if you are, you should really take a look at Nadex Go, where you'll find the touch brackets. First of all, it's just such a better experience right now. You don't have to worry about updates. The technology it's built on, it automatically updates. So just go to nadex.com on your mobile phone. I don't care if you have an iPhone or if you have an Android-based phone. Let's go to nadex.com. You can be taken right to the Nadex Go app. You don't have to worry about downloads, right? So you don't have to worry about going to the App Store or the Play Store and doing any updates or downloading it from there. It's such awesome technology, and it's so much lighter and more responsive. It's just I think it's one of the best things. So yeah, if you're not seeing them, you're probably not using Nadex Go, and I'm going to suggest that everybody should do that. Let's see. Yeah, so great question, Mark. I guess we can go in the bracket in the middle around 200. Yeah, you can trade in the middle of the bracket. I mean, you could trade it, you could trade it long, 20 ticks off the ceiling if you wanted to, right? You're going to put up more in risk than what your return is. But hey, do your thing, right? So you can trade it wherever. The way they're structured, though, is that they're structured so that, if you're looking to get in, mitigate that risk a bit and have a good potential upside. But certainly you can trade them really anywhere in the range. Obviously it's an exchange, so you got to have somebody willing to take the other side. But we have, we're actually getting more liquidity going there. These are new contracts. We're in the early days, so we're going to see a lot more size coming and a lot tighter markets, which I think just answered somebody else's question. Let's see. All right. Yeah, Leonard, you know what? Nadex Go is probably different from the platform you've been using to trade just binaries. So definitely check it out. By the way, it doesn't cost anything to do Nadex Go. I definitely encourage you to check it out. I think you'll find the experience so substantially better. As I mentioned, that really is one of my highlights from 2018, was seeing how that came together. Again, an awesome development, awesome teamwork across the board. And really, when I say awesome teamwork, I don't just mean internal here to Nadex. I mean our members. From the early stages, people were willing to get in, test it out, give us honest feedback. Whatever it is, and I can't stress this enough, we strive to always improve here. And I mean that sincerely. I think a lot of you have seen this, particularly across the Nadex Go app. Can we do everything we want immediately when we want? No, right? Things take time to develop, things like that. But we rely on your feedback. It's so important. From your apps, you can hit the feedback section. We take it very seriously. We want you to help define your experience at Nadex. Again, I can't stress that enough. And I appreciate everybody who's been our partners in that and provided that feedback right from the early days. And that's why I'm such a proponent on the Nadex Go. Can you trade grains, food, softs, and such? Not at this time. Right now, for the initial launch, it's the 4 markets. It's the four of the most major currency pairs, as well as the 4 U.S. Stock indices. Where do we download the new platform? That's the great thing. You don't have to download it. You don't go to a store. Go to nadex.com on your mobile app, and you should be able to log right in to the Nadex Go. Now it's actually browser based. So what you want to do is you want to save it to your home screen. So there'll be a pop-up menu that shows you, depending on if you're doing if you're on an iPhone, if you're on a Android, there's a different process for each. Make sure you do that, because then you can launch it just like any other app from your home screen. It's just so convenient. It gives you a much better trading experience. David, that's a great question. Right now, no. The question is whether Canadians can currently trade the touch brackets. Currently, no. Whether that's something that comes down the line in the future or not, but currently, no. Let's see here. Wow, these are flying in fast and furious. Okay, hold on here once. Geez, I'm having trouble even keeping track of a line. You guys are awesome. Let's see. Oh yeah, sure thing. Can you explain the discount leverage, please? Yeah. So in futures markets, you'll see different brokers. Again, Nadex is an exchange. I want to reiterate that point. We are an exchange. We're here to match buyers and sellers. That's what we do. So discount leverage is simply, if you go to a broker, they'll give you a smaller amount if you're just day trading. But really, you don't need that, right? Because if you're looking at a touch bracket, you already get all the benefits of that leverage, but not the unknown risk. Oh, hey, that's awesome. I really appreciate it. Just says, Dan, our guys love this touch bracket. That's awesome. You know what? The feedback's been great. Not perfect yet, but it's going to continue to improve, right, as we get deeper markets. And I just think overall, and when I hear it also from the long-time traders that have been in the markets for a long time and say they wish they would have had this, it would have been fantastic. Let's see. Alrighty. Sorry, we're still getting more and more. Trying to get to everybody. The mobile trading is a bit different platform than the web-based, right? You still go to nadex.com. It's just you're on your phone, but they're structured a bit differently. So yeah, it'll be a little bit different, but the contracts are the same. It's the same pricing. They'll just have a little bit different look and feel. Let's see. Oh, you're welcome. I hope you enjoyed it. Again, more questions coming in. All right, I think I only have 200 more questions to answer. Let's see. So the question is, new brackets will be replaced by 4-to-1 or 1-to-4 ratio brackets, even if the old bracket. It really actually doesn't matter what the ratio is per se. You know what? Let me flip back here, and I'll probably be able to explain this a little bit better as far as how when they're knocked out, this happens. So give me a second. Okay, so if you see there where bracket number 1 was knocked out, where the floor was, right? So the original bracket number 4 there, right, was 40 points, had a floor 40 points below the market and a ceiling 10 points above. So when bracket number 1 is knocked out, the new bracket is created. So now you have a new bracket, which is currently with a ceiling 10 points above the market and 40 points below the floor. And if they continue to get knocked out, it's going to continue on that. So it's less of a ratio than what it is dependent on the structure of each market, what the size of each bracket is. Let me hop back to my questions here. Lost my cursor. I trade with a desktop. How do I get to touch brackets? Right in the Finder, actually, where you find all of your other contracts. Down towards the bottom, just click on touch brackets, and then you'll have your choice of currencies or stock indices. No, you don't make a choice between the mobile or the web. I actually encourage everybody to do both, right? Even if you trade in your mind 100% exclusively on the web platform, um, you should always have a backup plan, right? The world is not a perfect place. As traders, we should know this. So if you would lose internet connection at home, you might still have mobile data. So make sure you have Nadex Go. Also, try it out in demo, right? Get familiar with the platform. So if it's one of those days where all of a sudden you lose internet at home, maybe there's a storm or something, or your computer dies, you can go straight to your phone. Everybody should always have that backup plan, right? Let's see. All righty, still getting a ton of questions coming in here. Let me see. I think I answered this. Yep, these are now available. So give me one more second here. I try to get as many of these answered as I can. By the way, because I know we're running short and I want to be respectful of everybody's time on this, if for some reason I don't get to your question, I'm going to be pulling the log of these questions. One, because it's going to help us formulate, making it better, seeing how we can create better education for all of our traders. Let's see. Looks like I answered some of those. Yep, only weekly contracts. Yep, so contract does expire if either the floor or the ceiling is touched, right? So it's somebody who's long the contract, if the ceiling is touched, that's their maximum profit potential. If somebody was short that same touch bracket, then that would be their maximum risk exposure. This is a good question. And actually, I'm going to answer this going kind of the heart of Nadex. The question is, can the big hedge funds get into touch brackets and easily sweep the book, or is there a max amount of contracts that can be placed? Robert, I want to answer that in a couple ways. First of all, your answer is no, or the answer for you is no. The reason being, we've actually set the position limits, particularly for the launch, at a fairly low level of 100 contracts, right? Now, that's great. When we look at these, everything we do is for the individual trader. Other exchanges can have all the institutions they want, right? We want to create a fair level playing field. We want to give people fair access to the financial markets in a sensible way, right? So $100, 100 total contracts, and let's say you could get in at $400, right? Right. That's not going to be enough to interest a hedge fund, and we do that because what we've created here is an exchange for individuals, and that's so important to our very mission, is creating that fair level playing field for individuals. Right. That was really how we're founded. Yes, so you can close these out at any point. You don't have to wait for it to see if it hits a floor or ceiling, right? Maybe you want to take a smaller loss than expected, or maybe you want to lock in some profit. You can use the limit orders to do that. Wow, let's see here. Oh yeah, this webinar will be recorded. Oh yeah. This is a good one. Yeah, I'll touch on it again. If you get a temporary spike over the floor or below the ceiling, it is closed out, right? That spike, right? Because markets can move so fast. We've seen the volatility, and I mean, geez, when we're looking at like say 600, 700 point intraday swings on the Dow, like we saw last month, right? Some of those looked very much like temporary spikes for the time being, but yeah, that would knock out if the Nadex indicative index for that market either is at or above the ceiling or at or below the floor. That's going to get closed out. And again, I'll reiterate, since most of you know we're closed for 1 hour a day, right, for exchange maintenance, things like that. So even if it happens over that close period, those contracts will still be expired, and so profits and losses will be realized, even if you're not sitting there. Let's see. Oh, this is a great comment. Actually, from a longtime friend of mine. But not just saying this because he's a friend of mine, but he was one of the first people to start trading binary options in Nadex a while ago. And it says he's just so excited about what these contracts offer. And I love binary options. I love call spreads. Um, I really think, and it depends on what you're looking for, right? In a trade. I think the great thing about touch brackets, even though I think they're all great contracts and offer different benefits, with a touch bracket, what it offers is that linearity. It will look so familiar if you're already trading, say, futures or forex, or if you get in, right? I think call spreads are a great contract, but that optionality and the way they're structured can be a bit intimidating and hard to understand, right? With the touch brackets, you don't have that. You have that linearity with the market, and that's so important. And wow, I mean, we are up on time here. Um, I still have a lot of questions to go, but I'm going to give everybody here my word. We're going to go through these questions. Um, we're going to get responses out. I can't thank you all enough. I mean, I didn't even read like all the kind of comments. The feedback is just overwhelming. They're available now in live and demo. Um, check them out. Love your feedback. And whatever we can do, that's what we're here to do, is take your feedback. I often say, we can be happy, but we can never be satisfied. And trust me, you don't want me thinking something's just a good idea and then implementing on the platform without some basis based on our members, right? So it's very crucial, and we really want you to work as a team with us. And again, I can't stress that enough. Anybody that was giving feedback on the Nadex Go app saw that process firsthand, right? We came on, we did town halls. By the way, when you see the town hall, this one was a bit different because it was all about product specific. Typically, those are the times where we have small agenda with updates from the exchange, but that's your time to ask questions. No question is dumb, right? Give us the feedback, and that's a great chance to have open flow and conversation. We want to be accessible to you, right? You're our members. That's what's important. So with that, and apologies if I didn't get to your question, I will do my best to do so very shortly. Want to thank everybody for joining us today. Your questions, your feedback, your enthusiasm, it's amazing. And I'm just looking forward. Want to wish everybody a very happy 2019. Hopefully 2018 was great for you, but I hope 2019 is so far beyond anything that 2018 could offer that we're just all loving this year. I know we've got a lot of exciting things happening. You know what? Whatever you do, always manage your risk. That's how I'm going to sign off. Have a great morning, afternoon, or evening, because we've got people around the world from here.